Hello, today I prepared 17 cognitive biases that junior traders and investors do. Mostly all of these cognitive biases related to fast thinking system, and if you want to find more information about this thinking system, please follow previous video in this playlist. These 17 biases I divided on three groups. The first group is related to personal perception of information and mostly related to subjective thinking. Let's start from basic cognitive bias, blind spot. Blind spot is related to all cognitive biases and is the cognitive bias of recognizing the impact of biases on judgment of others while failing to see the impact of biases on one's own judgment. One important thing is that until you realize this, you are not able to work with your cognitive biases well. Another important thing is that once you find a real case in your perception, you open a road to perceive the things your mind usually ignores or avoids. And bias is negativity bias. This bias refers to the tendency for people to give greater weight and attention to negative experiences, emotions, or information compared to positive ones. People who exhibit the negativity bias may be more likely to expect negative outcomes or emotions in the future, even when there is no objective reason to do so. This bias can lead to excessive worry, anxiety, or fear, and can also lead to avoidance or inaction due to a perceived lack of control. The negativity bias has evolved as a survival mechanism as it was more important for our ancestors to avoid threats and danger than to seek out opportunities for pleasure or reward. However, in modern life, this bias can lead to unnecessary stress and anxiety and can limit our ability to experience positive emotions and achieve our goals. To overcome the negativity bias, it can be helpful to focus on positive experiences, emotions, and information, and to consciously challenge negative thoughts and assumptions. It can also be useful to practice gratitude and mindfulness, as these practices can help to shift our attention towards the positive aspects of life. The example from investing decisions: when an investor doesn't like any asset by whatever reason he feels intuitively. Being aware of negativity bias doesn't mean that you should like all investment assets, but it can explain why you ignore some assets, and when you miss their movements, it allows to avoid blaming yourself and looking how you could miss it. The third one is commitment bias. It is also known as the escalation of commitment. It describes our tendency to remain committed to our past behaviors, particularly those exhibited publicly even if they do not have desirable outcomes. Beginner investors refuse to contradict themselves and stubbornly stick to their initial opinions. The key moment to avoid is to be open to new information and to be flexible to change own point of view on every important and common piece of data. The fourth one is tendency to make should statements. Should statements are statements that you make to yourself about what you should do, what you ought to do, and what you must do. They can also be applied to others, imposing a set of expectations that will likely not to be met. When we hang on too tightly to our should statements about ourselves, the result is often guilt that we cannot live up to them. When we cling to our should statements about others, we are generally disappointed by their failure to meet our expectations, leading to anger and resentment. The examples are: all men should do something this way, all women should do something that way, market should give me the profit, and so on. Fifth is overconfidence bias. This bias refers to the tendency for people to overestimate their abilities, knowledge, or the accuracy of their beliefs or predictions. People who exhibit the overconfidence bias may be overly optimistic about their chances of success, underestimate the likelihood of negativity outcomes, or believe they have more control over a situation than they actually do. This bias can lead to errors in judgment and decision making, as well as poor planning and preparation for the future. It's worth noting that some level of confidence and optimism is important for achieving goals and taking risks, but when it is excessive, it can be detrimental. To avoid overconfidence bias, it's important to stay grounded in reality, seek out diverse perspectives and feedback, and remain open to the possibility of being wrong or facing unexpected challenges. To avoid it in trading and investing, what you should do is to follow a protocol, rules, and a strategy which are defined by professionals. Finding the right professional among big offer is hard to do, especially when you are new in this, but this is the different topic. The sixth one is confirmation bias. This bias refers to the tendency for people to seek out or interpret information in a way that confirms their existing beliefs, while ignoring or dismissing information that contradicts their beliefs. People who exhibit the confirmation bias may be more likely to selectively focus on evidence that supports their beliefs or expectations about the future while discounting or minimizing the evidence that does not fit with their beliefs. This bias can lead to errors in judgment and decision making, as well as resistance to changes or to new information. The confirmation bias can be particularly insidious because it can lead people to become more entrenched in their beliefs, even in the face of contradictory evidence. To overcome this bias, it's important to actively seek out and consider alternative perspectives and evidence, and to challenge one's own assumptions and beliefs. This can involve seeking out diverse sources of information, engaging with people who hold different views, and adopting a more open minded and curious approach to new information. By being more aware of the confirmation bias and actively working to overcome it, we can improve our ability to make more accurate predictions and better decisions about the future. Confirmation bias shows itself clear when an investor continues to invest in unprofitable asset by making decision which is not based on real facts but based on subjective irrational meanings coming from preconceived notions, i.e., that his opinion was formed or is forming beforehand without adequate evidence. The trap of this cognitive bias can be long lasting, especially for investors, because investing cycles are long. During this time, when investor is open minded and has fresh perception, he can treat secondary factors and circumstantial evidence as primary factors and direct evidence. And later, based on this circumstantial evidence, he makes wrong decisions because global picture has been changed. For example, the trend has been changed from bullish to bearish, keeping secondary factors the same. In trading and investing, global situation can be analyzed with macro indicators and with monitoring of global economic and global market situation. The last one in this subgroup is hot hand in conjunction with confirmation bias. Hot hand, also known as the hot hand phenomenon or hot hand fallacy, is the phenomenon previously considered a cognitive social bias that a person who experiences a successful outcome has a greater chance of success in further attempts. The concept is often applied to sports and skill-based tasks in general and originates from basketball, where a shooter is more likely to score if his previous attempts were successful, it does while having the hot hand. Gilovich offers two different explanations for why people believe hot hand exists. The first is that person may be biased towards looking for streaks before watching a basketball game. This bias would then affect their perceptions and recollection of the game, which is confirmation bias. The second explanation deals with people's inability to recognize chance sequences. People expect chance sequences to alternate between the options more than they actually do. Chance sequences can seem too lumpy and are thus dismissed as a non-chance, which is clustering illusion. So traders use it to their hot hand during several successful deals in a row, more likely to start feeling and even believing in their hot hand little by little, losing their attention to protocol steps they followed initially. Another important case I need to tell you about: when beginner traders have a sequence of successful deals, they are still well warned and don't want to stop because of passion, especially if they are gamblers. So, after hot hand appeared in a trader's thinking, and after a trader has approved new motivation reward cycle several times, he might succumb to confirmation bias.